Section 301 of the U.S. Trade Act, a powerful trade provision the Trump administration revived in its bid to curb China's economic rise. Through this, Washington charged Beijing with intellectual property theft and destroying American jobs, and proceeded to impose tariffs on Chinese imports. While it's still unclear whether the Biden administration will continue with the new China tariffs, how is Section 301 worsening already deteriorating bilateral relations? What is Section 301? It allows the U.S. to single out certain practices of its trading partners and take unilateral punitive measures if they deem these practices in violation of trade law. In the 1980s, as Japan rode high on the wave of economic dominance, the U.S. used Section 301 to beat back Japanese imports of motorcycles, steel, and other products. This provision, however, has rarely been used since the creation of the World Trade Organization in 1995. However, in 2017, at the request of Trump, the U.S. Trade Representative invoked Section 301 to launch an investigation into China's trade practices, including alleged copyright law and forced technology transfer on U.S. companies wishing to enter the Chinese market. This year's 88-page Special 301 report mentions China over 100 times. The U.S. is closely monitoring China's progress in implementing its commitments under the United States-China Economic and Trade Agreement, says the report. It stresses that China must provide a level playing field for IP protection and enforcement, and open its market to foreign investment, and embrace open and market-oriented policies. Does Section 301 hurt China? Yes, it does, but it also impacts the U.S. Section 301 tariffs have been controversial since they were first imposed on China in 2018. Importers and other U.S. companies affected by the tariffs have complained that they harm their interests instead of leading to constructive changes in Chinese practices. The first formal litigation was filed by U.S. importers in 2020 at the Court of International Trade. As of today, over 3,000 complaints have been filed by U.S. importers, and more are expected. Even Treasury Secretary Janet Yellen has warned that the tariffs that remain in place have harmed American consumers. Obviously, the trade war has hurt both of the world's largest economies. For the directly affected export-extensive parts of China, research shows that the tariffs led to a 2.5% contraction in GDP per person. On the U.S. side, it has not led to the return of companies or economic activity and jobs to the U.S., at least in the short to medium term. The silver lining for American firms is that the trade war has given them the impetus to rethink their supply chains. The trajectory of China-U.S. relations suggests they have every reason to hasten the shift.